What restrictions do I need to consider when taking money out of my Roth IRA? Hi, I'm Garrett Ray, financial advisor here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to break down the distribution rules for Roth accounts. We're going to talk about penalties versus taxes, distributions from contributions versus distributions from earnings, how your age matters, and how the age of the Roth itself matters. Don't forget to hit the like and subscribe buttons down below us here if you want to catch other episodes of the Vault series. And okay, Garrett, let's go ahead and get started on this. When I knew that we wanted to do an episode on Roth distributions, I asked myself, how can we possibly lay this out to be as understandable as possible? Because there's a whole bunch of different things that matter. And I think I kind of came up with a fairly decent concept of this. So what I want to impart on everybody is that, as you know, a Roth account is after-tax monies that are designed to grow tax-free as long as you wait until 59 and a half to take the monies out. However, there's a bunch of caveats in there that either don't make that true or make it true sooner than 59 and a half. So we kind of want to go over all of that. This conversation that we're having today does not pertain to Roth 401ks and does not pertain to Roths that you may have inherited from somebody other than your spouse. So if that's the type of Roth you've tuned into this thinking this is going to give you the answers on some distribution rules about Roth 401ks or about some Roth that you inherited from a parent or from an uncle, do not listen to this episode for information about that. This is just about Roths that were opened in your names that are not Roth 401ks. Okay, having said all that, Garrett, the way that we're going to break this out is let's break it out by age and by
the age of the account.
The age of the account itself. But let's first be clear that there is a difference in the distributions between, are you taking money out of the account that was part of the money that you put into it in the first place, or is it part of the earnings of that account?
Yeah, the growth of the account.
The growth of the account. Yeah. So let's say, I always like to use round numbers here so people can easily understand this. Let's say that you put $1,000 into a Roth, and a couple of years later, whether it's 1 year later or 10 years later, you want to take out that $1,000 again. Well, that would just be the contribution that you made into the account itself. So there are different rules about taking monies out of the contributions of a Roth versus taking out monies that were the earnings. So if that $1,000 grew to be $1,500 over a course of years, the $500 growth, believe it or not, has different rules applied to that than the $1,000 that you put in there in the first place. So we're going to break this down by whether or not you are taking a distribution from the contribution of the Roth or a distribution from the earnings of the Roth. And those rules vary on whether or not you are over 59 and a half or under 59 and a half. All right, you with me so far? Did we already lose you? All right, so let's go ahead, Garrett, and talk about the simplest of all of them. Roths were designed by the IRS back in the 1980s, I think it was, to allow you to save for retirement where you were not getting a tax credit the year that you put the money into the account, like an IRA, but it was designed to give you a tax credit for all the years later when you took the monies out. Because if you put in $1,000 and it grew to $5,000, as long as you waited till 59 and a half or older, then you would not be taxed on any of it. So let's start off with the simplest of all scenarios. The person is over 59 and a half.
Okay, check.
And the Roth has existed for over 5 years.
At least 5 years. Okay.
What are the rules for taking out distributions in that case?
So congratulations. At that point, if you are over 59 and a half and the Roth has existed for 5 years or more, there are no taxes on that withdrawal and there are no penalties on a distribution from that Roth. So we will talk about, if you're here in a bit, if you're under 59 and a half, how some penalties may apply. So that is the simplest kind of best case scenario you can have for a Roth, is that the account has existed for 5 years or more, and you happen to be age 59 and a half years old or older.
Okay, so that's the easiest of them. Now let's start getting complicated. Garrett, what if somebody is over 59 and a half?
Okay.
They're ready to take a distribution from their Roth, but the Roth has not existed for 5 years. They only opened it 2 years ago.
Okay.
What happens in that case?
All right, so we're over 59 and a half. That's good. So we're getting towards that retirement window, or we're in the age that you would think that I would be a retiree and I'd be taking a distribution. But my account is less than 5 years old. What happens? Well, there's no taxes on distributions from any contributions you would have made. So going back to Brice's original scenario, if you put in $1,000, you take that $1,000 out, okay, no taxes on that. However, distributions from your earnings, in his previous example, he used $1,500, that $500 growth on your $1,000 contribution, those earnings will be taxed if you took them out. However, because you're over age 59 and a half, there is no 10% penalty for early access. Okay?
And that's the difference between taxes and penalties. So we have I should have added that in the beginning of this too, because I meant to, that there is a difference between the taxes and there's a difference between the penalties. All right, so in that case, somebody thinks, oh, I want to start not contributing to a Roth account. Maybe I want to start converting over to a Roth account, and they hadn't planned on the account having to be open for 5 years.
Right.
And they want to start taking distributions from that Roth, and they didn't let it cure for 5 years. Then what you're saying is they can, if they want to avoid all taxes and penalties, they can only touch the contribution of the account.
That's right. Only the contribution.
Not the earnings of the account.
Not the
all
earnings.
right.
Yep.
That's where a lot of people get slipped up there.
They do.
Why? Because that rule does not exist for IRAs. It does not exist for 401ks. It does not exist for non-qualified accounts. The only type of account that exists for is Roth accounts.
Yep.
It doesn't even exist for inherited Roth accounts. So again, very complicated there. All right, Garrett, then let's move on to the next one now, where what did we just do?
We just did I'm over 59 and a half, but the account hasn't existed. Hasn't existed for 5 years.
So let's now go into the third scenario. What if you are under 59 and a half, and does it matter whether or not the Roth is over or under 5 years at this point?
Not really, because there's still a penalty that we'll talk about. So if you're under age 59 and a half, there are no taxes on the distributions from your contribution. Okay. So again, back to Brice's original scenario, out of the original $1,000 scenario, you can take that out with no taxes on it. Okay. Because you've already paid taxes on it. Okay. Distributions from earnings are still taxed. And unfortunately, because you're under age 59 and a half, regardless if the distribution comes from earnings, your contribution, or a combination of both, they're going to tack on a 10% early withdrawal fee. Okay. So if you took $1,000 out, even though it was your own contribution, well, you're going to actually have to pay an additional $100 to access that account. Okay. That's just how it's going to be. Unless there is a caveat to that. There's a caveat.
A little asterisk here.
Yep. Unless it is a maximum of $10,000 for your first time home purchase.
So they do let you take a distribution from your earnings, as long as it's going to pay for a down payment.
$10,000 or less, and it has to be a down payment on your first time home.
First time home, then, or there's another exception too.
Or you become disabled.
Then the IRS allows you for that.
Yep.
Okay.
Yeah.
That cover it?
I think that's it. Yeah, that's all the restrictions. I know it's a lot to keep up with.
It is, but it really comes down to your age, and it comes down to the age of the Roth. Now, let's throw in this bit of information as well. Some people will think, well, I've got 3 Roths out there. This one I opened in 1990, this one I opened in 1995, and this one I only opened up a year ago. Well, the way the IRS looks at it is, what is the oldest dollar that sits in that Roth? That is what determines
the clock,
the 5-year clock.
Yep.
So it might not be that you put hardly any of the money into that Roth until last year, but is at least $1 that's sitting in that Roth from more than 5 years ago, then that's how old the Roth is.
Right.
But you might have another Roth over here that you never commingled those monies with, and that one's where you've got all of your money. Well, wouldn't hurt you to go ahead and combine those two Roths together, merge them together into one account. And now what's the oldest dollar that's been sitting in a Roth there? That determines the age of the entire Roth. So if you're thinking, well, a majority of my Roth monies are in this account that has the largest sum of them, and that's a newer Roth, so that means I can only touch monies over here in this Roth. Not necessarily true, not if you combine them. Yep. So that's how the IRS looks at the age rule, because I know that can get confusing for people as well. All right, I think that's going to go ahead and cover it for this episode. Again, feel free to hit the like and subscribe button down below so if you want to catch other episodes for us. Remember, as always, the markets are not going to wait for you. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.